If you're tired of being glued to your charts like I was, then you should probably start swing trading. This is a ICT swing trading model that I built out of the concepts that I've been using on the lower time frames. The basis of this model is utilizing the ICT weekly range profiles. These weekly range profiles just help you paint a narrative for the week. You're going to have an understanding of some specific concepts to utilize the weekly range profiles. These concepts are taught by ICT. These are the fair value gap, order block, and liquidity. Here I have an example of utilizing each of those. I don't exactly use them here, but I marked them out because these are levels that I would anticipate market to draw to and reverse from. So in this case, I would wait until the weekly range comes down into this weekly fair value gap and then runs towards all-time highs. Some of the concepts that you're also going to add to this model are the midnight open, daily candle close, 1 hour time frame, and weekly profiles. So basically what you're going to do is mark out each day's midnight open. This is basically telling you when it goes from Sunday to Monday, Monday to Tuesday, Tuesday to Thursday, and for the rest of the week. You're going to mark out each of these so you understand what each day does basically. You're going to pay attention to the daily candle close to tell you if it's likely going to reverse from certain areas or continue higher. You're going to do all this on the 1 hour time frame just because you can mark out the midnight price pretty easily and actually understand what happens on the lower time frames. And lastly, you're going to pair each weekly range with a weekly profile. I don't know if you guys can see this, but here we have a classic Tuesday low of the week where we had a 4 hour fair value gap. We had Tuesday run down, sweeping Monday's low, closing right above the 4 hour fair value gap and running towards this liquidity that was built up with the weekly range. Over here on the right hand side, we have another 4 hour premium fair value gap. This one was a Wednesday weekly reversal where we had Monday, Tuesday once again sweeping Monday's high. Monday's range is really significant because Tuesday tends to sweep it most of the time. In this case, it swept the high and ran towards like this weekly liquidity. And once it swept that, there was also a weekly fair value gap here. If we go on a clean chart, let's go on the weekly time frame. So we had this weekly fair value gap here, and it's specifically this wick right here. I remember this range. That's when we ran down into this weekly fair value gap, consolidated, and ran back up. So this was a Wednesday weekly reversal, basically a midweek reversal. Wednesday swept all the liquidity and started running back up. That's basically all you do. You just mark out what each day does and anticipate what it's going to do. From running into specific concepts, sweeping days of the week's liquidity. Here we have another example from I believe this was this last week. Once again, classic Tuesday low of the week. We had Monday's low, we had Tuesday sweep the low into a daily fair value gap and run up towards this premium fair value gap. So that was this last week that I was showing you guys. We had Monday's low. Monday's low was swept into this daily fair value gap. So you can see that's this daily fair value gap here. Let's go on the daily chart. Daily fair value gap here. We had the lows and then we swept into it, barely tapping into the high of this daily fair value gap and running back up. That was here. Running back up. Boom. Sweeping Monday's high, coming back down and running towards this daily premium fair value gap. That's the premium fair value gap right here because it previously didn't run towards the midpoint of this one. So that was a highly likely drawn liquidity. We can also take a look at the week before this one because this last week was just a consolidation. We had Monday, Tuesday, Wednesday consolidation. We had Thursday, Friday consolidation. And then news finally swept both sides and ran towards the premium fair value gap for the first time. But the week before, we also had a classic Tuesday low of the week. We had Monday consolidate, create a range. This is why people say don't trade Monday. It's not likely to do anything high probability. But if you want to paint the narrative, then you actually look at Monday's range because it's significant. You wait for Tuesday to actually do something about it. We sweep Monday's low, then we run towards Monday high. Consolidate. We finally run towards this daily premium fair value gap. And Friday you could have got that TGIF sell, where it's likely to retrace the entire weekly range into the 0.2 and 0.3 of this range. So we take the weekly low to the weekly high, and my Fibonacci is already on it. Obviously, you got a much deeper sell than this because it was likely targeting this low here. We had a bunch of accumulated lows that weren't swept. So you can see that TGIF would have gotten you that sell from the top. You just trade this order block. Boom. You get that weekly range. But that's not important. What's important is understanding and being able to execute based off of the first few days of the week. So you have Monday or Tuesday even range. And then you look for Wednesday to do something about that range. Maybe you get a huge daily fair value gap created on Tuesday. Then you wait for Wednesday to tap into it and run up higher. That's your trade. You basically get in on a lower time frame based off of the higher time frame confluences. People say, how do I trade the higher time frame? Or how do I have a draw on liquidity? How do I know what it's going to do in the span of a week? What's a weekly bias? It's basically using the same ICT concepts that you would use on a 5-minute time frame, except you use them on the weekly time frame. Just like this. I marked out all my fair value gaps here. I was just showing you guys, but I would just have the significant ones. So here we didn't actually sweep the midpoint, so it's going to be a draw on liquidity eventually. Once it starts running down, that's going to be my first draw on liquidity. We also have this fair value gap here. That's another draw on liquidity. So I'm going to mark that out. I'm going to see how the market reacts to it. And if it uses it to go higher, lower. Next thing we're going to talk about is what's most significant. We have the weekly time frame. So you're obviously going to want to start from the weekly time frame because the weekly time frame is going to paint the narrative on the higher time frame. It's always going to respect weekly over the daily. It's always going to respect the daily over the 4-hour time frame. So always start from the highest time frame and work your way up. Next thing, daily inefficiencies. That's going to be the lowest time frame that you're going to use for draw on liquidity. And then 4-hour, 1 hour should just be used to mark out all the stuff that goes on the lower time frame, liquidity, get you your entry. It shouldn't be used for a draw on liquidity. It should be used as confluences to push you towards your draw on liquidity. So wait for 1 or 2 days into the week to identify that higher time frame inefficiency target. And then once something significant occurs, like Tuesday sweeping Monday's higher lows, identify which draw on liquidity you're going towards and then just execute from that. Here's some risk management rules. Your stop loss should be always secure above daily, weekly levels. Your TP should be at consequent encroachment. So like I said here, whenever it doesn't run into the midpoint, let's see, this daily fair value gap, it didn't run into the midpoint, it missed the midpoint. That means that these highs right here are so likely to get swept. You basically just have your draw on liquidity as the midpoint. Partial rules, you should always take partials when you're swing trading because you never know when it might barely dig into some inefficiency and turn around completely. And then for me, I personally risk 1% on every trade. And you want to have a big stop loss. So depending on what your account size is, calculate how much 1% risk is and how much 1% risk is with 100 pips. Then use the lot size that will allow you to risk 1% with 100 pip stop loss. And then obviously red folder news is one of the main things in the weekly range because that's what tells you whether you can hold it throughout the morning, from London session to New York session, if there's some morning news like this. Then if news works against you, what I'm basically saying is that there's some news that doesn't allow you to hold, from, say, Tuesday to Wednesday. If Wednesday had some fat news, then you either don't trade, you start scalping after the news, or you swing trade from Asia to New York, because basically Asia is the start of that daily range, and you have about 6 to 8 hours of swing trading. You can trade from Asia to New York, and then you could close your trade before New York session starts and avoid the news. So I was specifically looking at this weekly fundamentals, all the news, red folder news for USD, because I trade a USD based pair. These are weeks that I like when it's missing news on some days of the week, but it still has them on others. This means that I can likely get a really nice trade either Monday or Tuesday and hold it throughout the rest of the week, because unemployment claims isn't a very strong news, so it's not likely to run 100 pips and stop me out. So this would actually allow me to hold until my target. These weeks are weeks that you should prefer. You also do not want to start trading without red folder news, because then it's likely to consolidate and you're not going to get any real weekly movement. That's going to be all. That's my weekly trading model using ICT concepts.